Microsoft Corp, ticker symbol MSFT, is currently trading at $447.05 a share. Over the last year, this stock has only been up 9%, with highs of 146 and lows of 385. Now, they have their earnings around the corner, Q2. And is this the right time to buy? What we're going to be doing is looking at their prior earnings, seeing what we should look at, seeing what we're expecting, and then going to my automated stock valuation spreadsheet to see if Microsoft is a buy using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Grimm formula for intrinsic value. So let's just put in the ticker MSFT, and this will load up all the latest company financial data. But as that is loading, I just want to look at the stock over the last 5 years. Now, it is up 162%, and if we compare it to the S&P 500 over that time, the market is only up about 90%. So it has beaten the market over the last 5 years, despite its relatively flat, well, up 9%, but not beating the market, which is up at 23% over that same time. Let's have a look at my sheet here. 447, $3.3 trillion market cap, P ratio of 36, which is only slightly higher than the market average, which is 30. Earnings per share, $12.11, and a beta of 0.9, meaning it is less volatile than the market. Analysts saying it is a buy, $509 a share. Now, they do pay a dividend. This is recent, 0.75%, meaning you'll get paid $3.35. Is it a safe dividend? Yes, it is, very much so. 27% of the net income and 35% of the free cash flow, of the free cash flow. If you want to get paid the dividend by before the 20th of February of this year, and you'll get paid your quarterly dividend. So we have the numbers here, and let's have a look at the revenue. Revenue, all-time highs in the trailing 12 months, $243 billion. They have consistently grown revenues every year from, well, you can see here, their only down year here was 2016, but over the more recent time, over the last 5 years, have consistently grown their revenues. Now, if we do look at, this is my Patreon, sorry, if we do look at the earnings of the prior quarter, you can see here, this is the 3 months ended September 23 versus 24. Product was down slightly, 15.5 to 15.2, but service and other up massively, about 10 billion. Overall total revenue from the quarter is up to 65 billion from 56. If we look down here, we can see how this is broken out. If we keep on scrolling, there are 3 segments: productivity and business processes, intelligent cloud, and more personal computing. Productivity and business processes is a portfolio of products designed to enhance corporate productivity, communication, information services. For example, the Microsoft Office software suite, and also Dynamics 365 and LinkedIn. And that is their largest segment currently. Went from 25 billion to 28.3. But if we look at the intelligent cloud, this has grown quite a bit, 24.1 billion. This is the Microsoft's public-private hybrid server products as cloud services for business. This includes Azure, SQL Server, Windows Server, GitHub, enterprise services, and many more. And this is up massively and growing, and could be potentially their largest segment. It will be interesting to see in the next quarter or in the next earnings. And then we have more personal computing. This is Windows OS, Surface device, gaming products, and also search and advertising user included in this as well, and is up 11.2 to 13.1, which brings us to the quarter of 65 billion. So revenue is growing, that's the long and short of it. Net income, they're generating more profit, 90.77 billion, all-time highs, growing as well. Free cash flow, all-time highs, 70 billion. If we look at the operating cash flow versus the CapEx, if I scroll up, operating cash flow is up massively. Look at the CapEx spend here, up a lot, but free cash flow is still growing. So operating cash flow has jumped up massively. If they were cutting their CapEx, it would be up even more, but they're spending way more than they ever have, and probably at a higher percentage looking about that, which is good to see. Shares outstanding, they're buying back their shares, rewarding shareholders. So let's have a look at the discounted free cash flow model. This is where valuing stocks, looking at their future free cash flows and discounting them to today's value. It's currently giving us a price of 255. Let's see if we agree with that. Revenue growth rates, we're expecting 68 billion and 295. Let's see if analysts agree with our estimations. In fact, they are saying a little bit more bullish, 278 and 318. So we will be a bit more bullish as well. We'll bring this to about 15%. $300 a share. Net income margins increasing, as we can see here. So we'll go with about 38%. 300. Oh, sorry. If you put a apostrophe in there, it's not going to work. $322 a share. And net income to free cash flow, I think we can go slightly higher at 77, but probably not a buy. $350 a share. But it does show how much that this sort of fast-growing, still tech giant, discounted free cash flow, doesn't hate the stock, but does think it's a little bit overvalued. If you're interested in my Patreon, check out my links in the description. It's a $4 tier for the automated spreadsheet, which you see now. You get full access to the spreadsheet and all of its underlying data, and you can run these models as well. Dividend discount model, I don't think it's going to like it too much, but let's see what it says. We will increase the... Yeah, so this is... Oh, well, that we wish. So if they could grow their 7.5, 7, we'll do 8.1. 7.9. Yeah, so if they... Yeah, the more I use this, the less I like it, but it is quite interesting to see. For them to be fairly valued, you'd need to do at about... They'd have to keep on growing their dividend. So it's saying the dividend discount model, if they grow it at their current rate, it is a buy, which is quite interesting to see, actually, even though it is a lower dividend. But because they're increasing about 10%, the model actually does like it. So that is quite interesting. I don't know if I like this model, but it is an interesting part of it that does say it is probably undervalued based on the dividend discount model. Ben Graham formula for intrinsic value looks at earnings per share, PE of a non-growth company, AAA bond, corporate bond. We'll quickly look at what analysts think Microsoft is going to grow. I clicked the wrong link there. They're expecting about 15% in the next year. $240 a share, so no, not a buy. Finally, we will look at the comparable company model. This is a way of valuing companies, looking at their competitors, and then we can compare against them. So I want to do it against sort of two sections here. Firstly, we're going to look at the other large constituents in the S&P 500 that still are very similar. And we'll do Google, we'll do Amazon, and we'll do Apple, APL. Obviously, Google, competitor in cloud computing, AI, and productivity tools. Amazon, main competitor is on the cloud services, and Apple, tech leader in hardware and ecosystem-based software. But this will load up all the latest company financials and we can have a compare. Largest company here is Apple, 3.3 trillion compared to Microsoft, second largest. Revenue, interestingly the smallest revenue. Revenue growth towards the middle bottom. EBITDA, highest. Net income, almost highest. Biggest margins, 37%. Price to sales, price to book, it is towards the highest. PEG, which is Peter Lynch's price to earnings growth. Ideally, we want this under 1. All of these are above 1, and Microsoft is the highest. The metrics we're looking at: EV to revenue, EV to EBITDA, PE, and forward PE. The only one that says it to buy is, interestingly, is the current PE because of Amazon's very high PE. Forward PE, it is the second lowest, so puts it about $374 a share. So slightly overvalued. They all say that Microsoft is slightly overvalued at the minute, which I do think is interesting. But obviously these numbers will change depending on their earnings in, well, I'm recording this, but it'll probably be tomorrow when this video is released. Also, I want to compare them to Oracle. We'll do CRM, and we'll also do IBM. Oracle being obviously enterprise, computer services, and cloud. CRM, Salesforce, which is customer relationship management, and IBM, which is sort of a hybrid cloud. Won't go through all the details here. Highest revenue growth rates apart from Salesforce, highest net income, biggest profit margins, and puts it slightly overvalued for 20. The EV to revenue and the forward PE, but yeah, quite interesting to see here. So Microsoft currently maybe overvalued ever so slightly. That is what the models are saying. But with their earnings tomorrow, tomorrow when it's released, especially with obviously DeepSeek as well, it's going to be pretty interesting to see. I'll be releasing a video once that is done, and we can see with the update numbers what the model is saying. But should you buy before earnings? I wouldn't gamble on it. Let's just wait and see. We're more long-term investors here. Right, guys, thanks for watching. Please give a like on the video if you haven't already. Subscribe if you haven't already. And check out my Patreon, and I'll catch you guys next time.